Hey, happy 4th of July, everyone. A lot has changed over the last 2 weeks. Some really big changes in the housing market. That and more dominoes continue falling into place. So let's not hesitate anymore and let's get into today's housing market update right after this. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida. And on this channel, I bring you the latest news so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. If you're new to the channel, welcome. And if you haven't already done so, please consider subscribing and hitting that bell so you don't miss out on the latest data, tips, and news keeping you ahead of the market trends. All right, so over the last 2 weeks, we've seen some really big changes in the housing market, and I have a lot of data and a lot of stories to cover this week, so I don't even want to waste any more time. Let's get right into it, and we'll throw up the screen. So these are some of the stories that we're going to be talking about. Like I said, I have a lot to cover, and they are really all important as far as what is going on with the economy and with the housing market specifically. So before we get into all of these really big stories, I want to just first go over this the local data. And this week will be the first week where I'm actually going to split Southwest Florida into a northern half and a southern half. So the southern half will be what I usually cover, which is from Cape Coral all the way down to Marco Island, Naples, Fort Myers, Bonita Springs, Estero. And then the northern half is going to be from Charlotte County, Punta Gorda, all the way up into Tampa. So we're going to be going over those details, and I do have stats from last week to compare so we can see how the market has changed in both halves. All right, so taking a look at the Cape Coral to Naples new listings. This is from 2 weeks ago. Since I missed last week's update, I'm going to be doing two separate slides, one covering last week's update, one covering this week's update. 2 weeks ago, new listings went from 811 to new listings last week, 927. That went up 14% for new listings, which has been the trend. And then we had solds went from 801 to 761. So that went down 5%, which is also in line with buyer demand decreasing. Solds, however, are 30 to 45 days lagging indicators. Pendings, which are the leading indicator, that was down 5%, went from 809 to 769. So now comparing 2 weeks ago, the single families with the actual inventory breakdown happened to be, we went from 4033 to 4359. So that went up 326 new listings of net gain. Condos went from 1921 to 1997. That was a 76 net gain. So we had a net gain 3 weeks ago of 43. And then last week, the net gain was 402. So we had an increase of 402 new listings on the market total. Multifamilies went from 143 up to 166. That was one of the largest week over week increases in multifamily units coming on the market. So that was up 23. And then foreclosures, we only lost one, really no big changes there. So this is this past week. From last week, we had 927. This week, as of today, July 4th, 848. And that is down 9%. So even though that went down 9%, that's just simply because we had so many the previous week come on the market. Solds went from 761 to 938. Again, this increase, I believe what it was due to is the fact that a lot of buyers who have been sitting on the sidelines are seeing interest rates go up. So I think they really kind of capitulated and said, if the rates are going to continue going up, I better buy now. So we saw an increase actually in the amount of sold homes in May. In June. So that actually did increase a bit over the last 2 weeks, but it has been going down consistently. And that was just, I think that was just a fluke and happened to be a capitulation in the buyers. So that was up 23%, which is a huge amount. Again, that is still a lagging indicator. The leading indicator, which is pendings, are still down 4%. We went from 769 to 741. And then if we take a look back at the previous week, the 808 for price decreases, that was the single newest high for the actual price decreases. So you can see that we're still hitting all-time highs. But now when we're looking at this week, 724, although that's not an all-time high, that is still very, very high considering. Back in February, if you were to compare to, we were around the 200 price decreases on the market, 180 to 200. Okay, moving on to this week's inventory breakdown. We went from 4359 last week to 4511 this week. That's still up 152 new single-family units on the market completely. Condos went from 1997 last week to 2031 this week. That's up 34. So we had a net gain of 402 last week to a net gain of 186 this week. So net gains meaning that more listings are coming on the market than are going off. So we're gaining amounts of homes on the market. Multifamilies only up 3, 166 to 169, and foreclosures only up 2. So we did see a little bit of a gain there, but not too much. Now breaking off into the northern half, Punta Gorda all the way up to Tampa. New listings last week were at 2204. This week, new listings went up to 2145. That's actually down. That was only down about 5%. So sorry, this slide is incorrect right now. The numbers. Price decreases went from 1953 to 1833. That is down also almost 10%. And then pendings went from 2014 to 1969. So that is down. So right in line with what we haven't seen other than the new listings in this area. Pendings are down, which is the leading indicator. The lagging indicator being the price decreases and the solds. So solds went from 1998 to 2354. Again, this week over week capitulation in buyers, I believe, is why we have seen a little bit of a spike in solds. But overall, the the leading indicator pendings is down again. So we will be seeing more inventory coming on the market. And now, while this is brand new and I really don't have a lot of week over week data to compare to, I did want to put this in perspective in chart value. So the last time we saw, if you see on the graph on the right-hand side, you can actually see that over the last couple weeks and over the last month or two, we have seen inventory begin to rise again. Although it's not, really not up to its all-time highs like it was back in 2019. The last time we saw 26,000 units on the market, which is the latest one that we had come in for June. The last time we saw that was in December of 2020. So it's been a couple years since we've seen that level of inventory hit the market again. And month over month from 23,444 to 26,363, that's a 3,000 listing gain in 1 month. So if this trend continues, I believe we will be right on par and track with what we've been seeing in the southern half of Southwest Florida as well. Good news on the interest rate front. As of today, the interest rates, according to NerdWallet, went down to 5.39. That was down from 5.68 2 weeks ago. Bank rate had their average grow from 5.99, so almost 6%, down to 5.61, which is negative 38 basis points. And what I really want to show you now, before we get into the wall of worry and the stories, I'm going to just take you over to the actual 2-year bond, because if you're wondering where mortgage rates are going to be going, the 2-year bond is a pretty good indicator as to where it is going. And all you really need to do is take what the 2-year bond is at right now and add about 2.5 percentage points to it. So that'll put you right about where we are at for the current interest rates. So add 2.5 to 5.8, and you'll get right out to about the 5.3 percentage points, which is right around where NerdWallet and Bankrate have us on average. So that's a good indicator. And as you can see over the last, so this is in June 14th, over the last few weeks, you've seen that the 2-year bond has been declining now. So we're going to get into a story later on Michael Burry's prediction with the bullwhip effect, but pretty much essentially a lot of people now are starting to call that the Fed may be reversing course sooner rather than later. They might not be able to continue tightening as much as they will because they do really follow the bond market. Also wanted to give you an update for just a graph, just some visual actual data of what's going on in the market. So this is the sales price, and this is the average sales price over the last 3 years. As you can see, over the last month, we've seen a huge decrease from 767,000 to 681,000. So this is the average sale price. Part of that has to do with the amount of luxury homes that are not coming on the market as much anymore. But that also is part of the story with what's going on with buyer demand and the current market conditions. New listings. Now, this is for the entire MLS, which does include lots coming on, things like that. So overall, it is still down. But when we're looking at single family homes and condo units in our particular area, which is mostly focused on Cape Coral and Fort Myers area, the entire MLS is showing down, but we're actually seeing that those new listings rise. Same thing with home for sales, pending sales, closed sales. You can see that closed sales have been tanking over the last month. We went from almost 4,000 down to almost 3,000. Month supply, we did hit a low of 1.4 months supply in the total MLS. We're now back up to almost 2 months, and that is going to continue rising as long as interest rates continue rising as well and demand continues falling. All right, now let's get right into the first story that I wanted to talk to you about, which is Redfin's latest release just about 2 days ago now. 3 days ago. The housing market updates asking prices come down from all-time highs. So record shares of home sellers are dropping their prices after this month's historic mortgage rate hike. Data on the home tours, offers, and mortgage purchase applications suggest that home buyers have noticed a shift in the power and are no longer leaving the market in droves. So that goes back to what we saw, the little uptick in the amount of buyers who are buying, because the interest rates have come down a little bit, and they're starting to get worried that those interest rates may continue going back up. But between now and the end of the year, the economist here, Daryl Fairweather, thinks that power will continue to shift towards buyers, resulting in mild price declines from month to month. Home buyers are worried about interest rates, having to go back to the office, getting laid off, and wondering if they can get a better deal by waiting out the market, which are all things that I've been talking about over the last 6 months, really. And we are starting to see those layoffs play out even more, and I think those are going to actually continue getting worse. There's actually another story that we're going to talk about with the Fed and their stress test with banks. Their most recent stress test for 2022 and their supposed conditions that they were putting on the market, which could be, could be the things that we're probably going to be seeing coming up in the market, though I won't call it a prediction. Other things to take a look at: the 30-year mortgage rates fell slightly, 5.7%. Fewer people were searching for homes for sale on Google. That was down 7% from a year earlier. Requests for home tours and other buying services from Redfin agents was also down 15% year over year. And then also mortgage purchase applications, as we said, are down, but they were down 24% year over year. So those are all pretty strong signs that we're seeing a decline in the inventory and the buyer demand in the market. This was a huge story on Bloomberg. I'm surprised more people weren't covering it, especially like places like Redfin and Zillow. More than 8 million Americans are late on rent as prices increase. That's a huge amount of people. Just think about the domino effect of that. 8 million Americans are late on their payments. That's landlords who aren't making any cash flow or money to pay off their mortgages, so they're losing money. And if this really continues to play out, which I think it's going to, based on where the economy looks to be headed, you're going to see a lot of probably. I would assume you're probably going to see a lot of investors second guessing whether they want to continue being landlords because they can't make the payments. On top of that, the people who they would be probably, once they evict the current tenants, the people that would be coming into the market are going to be struggling just as much because they're probably going to be raising prices to try to meet what the actual market is suggesting the rent should be. And that's going to squeeze Americans even more. So more will feel the squeeze as leases come due in the summer. A lot of leases do come due in the summer. About 15% of renters, landlords boost prices, 8.4 million Americans, June 1st to June 13th period. That's where they actually had this census. So this is a recent survey that is suggesting that. So if you take a look at the evicted, the likelihood of having to leave in the next 2 months by household income, people making less than $25,000 a year, 1.6 million Americans. That is a huge amount, and I can understand that making that much money. How difficult it must be just looking at the rental prices the way they are right now. As you can see, they continue to fall off, but 1.6 is a huge amount, and that's probably a pretty safe bet. As a majority of those people are probably going to face eviction. Then you move up into the next bracket, 731,000. That's pretty close. That's, three-quarters of another million. So you're now looking at over 2.5 million people in just those two brackets. Then you move up to the next one, and now you're at 3 million. So, and it continues to decrease, obviously, but 3.5 million households say we are very or somewhat likely to leave their house in the next 2 months because of eviction. So now the eviction process does take some time to play out, but this will be more inventory that could potentially be coming to market, not necessarily coming to market to the individual homeowners, but it could be, more opportunities for larger hedge funds and bigger conglomerates to buy these kinds of properties up, which could potentially make things worse. So the rent increased by at least $250 per month for 6.7 million households, which is no surprise, as we've been seeing 30% increases in a lot of different rents. About half of families with kids enrolled in free or reduced price school meals programs said it's somewhat or very likely they will be evicted in the next couple of months. So unfortunately, this is obviously not what we want to see, or not the way that we want more inventory to come to market, but this is something to keep an eye out, and we'll be looking out for it on Adam's data coming up. Lennar starts cutting prices and cooling U.S. housing market. So Lennar, if you're not familiar with them, they are one of America's largest builders, and they are on the stock market. So you can watch their actual stock price change, which is a pretty good indicator of how they're feeling about the current market conditions. But Lennar Corp has started trimming prices and offering buyer incentives in some areas. I've been talking about this for quite a few weeks now, ever since the builders have started to contact and outreach to a lot of the real estate agents in the markets. The executive chairman, Stuart Miller, said the company's earnings statement, he warned about the slowdown already underway, calling it complicated moment in the market. 7 regions had significant slowdowns this month, Lennar said. They were Raleigh, North Carolina, Minnesota, Austin, Texas, Los Angeles, and Central Valley and Sacramento in California, as well as Seattle. The mortgage rate buy downs, that's one of the incentive programs that I've been trying to tell most of the people about. A lot of the builders are starting to do buy down programs for interest rates, where in the first year, instead of paying what the current market interest rates would be, around 5.5% to 6%, the first year they're doing something like 2.75%. The second year it would go up to 3.75%. The fourth year it would go up to what will be locked in for the remainder of the loan over 30 years, which is usually around 4.75%. So there are some big builders that are doing things like that. So keep an eye out if you are interested in purchasing. That is a way. And if the Fed does reverse course in 1 year or 2 year or 3 years, that 4.75% interest rate may be even lower, where you could potentially refinance to an even lower rate. But at the worst case, it's a lot better than taking out an ARM, which in 5 years, who knows where the interest rates will be. And when those come due, you might be paying a lot higher interest rate than you would be in the beginning. Lennar and other builders will need to manage the effects of rising interest rates will have on demand, and that may include having to drop prices to lure in buyers, which has started to happen already. All right, moving on. Adam. So Adam is one of the leading data providers for foreclosures and real estate data. Rising prices and mortgage rates, obviously, we already know about all this. The homeownership unaffordability across the nation, showing that the median price single-family homes and condos are less affordable in the second quarter of 2022 compared to historical averages in 97% of counties across the nation with enough data to analyze. So that is a huge amount. That's saying that almost all of the counties that they analyzed, houses have become unaffordable. So if that's not a pretty good indicator of us being in a housing bubble of some sort, which I believe has been caused by the Federal Reserve's, I guess their easy money policies that they've been using, I don't know what is. Home buyers are faced with monthly mortgage payments that are between 40 and 50% higher than they were a year ago. And that wasn't even at the start of the housing boom. So payments to that many prospective buyers simply can't afford. Most of us already know that. Major ownership costs on median price single family homes and condos around the US now require more than 28% of the average $67,000 wage in the US, a ceiling considered affordable by common lending standards. So they're already above that now. The current level, 31.5%, stands at the highest point since the second quarter of 2007 and is up from 26% in the first quarter of 2022 and 23, almost 24% in the second quarter of last year. Both of these are the largest jumps since at least 2000. So we have to go all the way back to 2000 to see jumps like this. May marked the fifth consecutive market of lower existing home sales than the prior month. And I've just zoomed in on the map. This is a interactive map, so you can zoom in on it and hover over the areas. So this would be Collier County, which is Naples and Immokalee. So annualized weekly wages, the annualized weekly wage, if you annualized it, it would be around 60,000. The population, 375,000 people. The median sales price, $595,000. So they're making 1% of that. 10% of that is what their annual income is. So for those of you who are familiar with the 1% rule with investing, just think about that on a scale. They should really be their monthly expenses shouldn't be hitting any more than 28%. But if the housing price is already their annual wage is 10% of what the housing prices are average, you can see that the wage growth of 10% is not going to keep up with that kind of demand when year over year price growth is up 30%. So they're only growing their wages by 10% and you have appreciation at 30%. There's just no way that that's sustainable. Same thing when you go into Lee County, Cape Coral, and Fort Myers. Annualized wages, 52,000. Population is quite a bit larger, 760,000. But the median sales price is a decent amount lower. So that's almost $400,000. But wage growth was only 5% higher and home price growth was 32% higher. So these numbers are just really not sustainable. And if you want to check it out yourself and go through the map, you can see the whole US and check out which areas and counties are the hottest or the largest bubbles. But basically, the bigger the circle, the larger the bubble in that market. You can see Collier and Lee County both have pretty large bubbles. When you zoom out, you'll see that the bubbles continue getting larger. So one of the issues that is specific to Florida and has happened as a result of the Surfside collapse, I've been talking about this a little bit. Insurance has become a big issue in Florida right now, and especially for condos, with more so in high rises and multi-level condos. But Florida condos start to see the impact of that Surfside collapse. Tragedy rattled Florida insurance. One Palm Beach condo complex expected a 25% increase, which is, that would be expected, reasonable. But the coverage actually rose by 82%. So this is where the issues start to rise and mount. McSwain, 67, said her dues are going from $914 a month to $1,347. So that's almost a 50% gain in just a couple months. And that's a burden that a lot of people, if you think about it, in Florida, a lot of people are on fixed incomes. When you have a 50% increase in your monthly expenses, those are fixed expenses that people were not expecting to rise, at least not rise that much. That puts a huge burden on those people and starts to make, is it worth buying a condo to have the HOAs paying for that, where the insurance, things like that. Gardner had just 3 companies willing to give him a quote after the association got notices it's insurance. So that's the other issue. A lot of insurance companies have left and are fleeing Florida. So there's not many left, and that's putting a huge burden on the state's insurance, which is actually now they're paying out a ridiculous amount of money right now every month just to combat lawsuits from what's going on in the insurance industry. They are trying to work, and they have passed some legislation, but that's not likely to kick in till 2024, which doesn't really help people in the meantime for the next year and a half to 2 years. So years of lax oversight, weak regulations, and volunteer condo boards reluctant to levy heavy dues on their friends and neighbors have allowed buildings to deteriorate. And this is where the problems come in. Um, Champlain, just to give an example, Towers South had about $706,000 in its reserve as of January, which is a pretty decent amount, considering when you look at a lot of these condo associations, especially the smaller ones. But according to the review the year before by the company Association Reserves, it needed more than $10 million for projected repairs. So it wasn't even close to having enough money in its reserves to make the repairs that were going to be needed to keep it. And what is that going to lead to? Well, it's going to lead to a lot of condos, unfortunately, selling to big builders and big developers. So an April Wall Street Journal article notes that a handful of Miami area condos have already sold to developers. That's something that we're going to continue seeing. Vicky Ross 79 was canceled from her private carrier earlier this month and had to enroll with Citizens, which is the state's insurance company, and that included a $500 rate hike. So her association dues will go up $433 a month. So that's what people are facing, and a lot of them are saying things like, "I just don't know how many more increases or special assessments there can be." But really, it comes down to meeting the codes and getting the buildings up to date, which a lot of them have been neglected over the years. Moving on to the next story. So this one was in Zero Hedge. It's a great resource if you don't use it, zerohedge.com. Zuckerberg actually warned Facebook employees to brace for layoffs, and he's quoted as one of the worst downturns in recent history. So that's considering both 2000 and 2008. So he's expecting a pretty massive layoff wave. Just to kind of give you an idea of what's already happened, this chart shows all the layoffs that have already been announced. So 2,800 from Peloton, Better 3,000, Wells Fargo, it was 10% if I remember last. Robinhood 380, and Robinhood's kind of in trouble a little bit right now. GoPuff, yeah, you got Noom, hiring freezes throughout Meta. Sezzle, 20% of the company, 750 at Reef Technology. So this list gives you it. You can go to zerohedge.com and just look up that quote from Zuckerberg. But according to Reuters, Facebook owner Meta Platforms, which will likely be undoing its name change just as Bitcoin bottoms, ironically, has cut plans to hire engineers by at least 30%. So that's a big, that says one thing. One thing it says is that look at how fast Meta has been growing. I mean, they were planning on 10,000, hiring 10,000 engineers. They cut that 30% to between 6 and 7,000 as they brace for the deep economic downturn. But Zuckerberg said, if I had to bet, I'd say that this might be one of the worst downturns that we've seen in recent history. And if you think about it, Meta is one of the largest platforms for advertising and marketing. So if anybody's going to know anything about what's going on in the economy, it's going to be told through the amount of people who are marketing with Facebook platforms. And you can very easily see all that data through Facebook. You can even see what your competitors are doing through some of the Facebook tools. You can see their exact ads, their copy, and everything. But Zuckerberg would have that information on what's going on in the economy and what's probably going to happen. So if he's saying this, I'm willing to bet he's probably right. A lot of us have been saying this for quite some time, but if you're listening to mainstream media or CNBC or a lot of those other, big financial stations, they're all saying, even the Fed's saying we don't see a recession in the near term, even though we're going to go into the story, the GDP, but we're already in the recession. So those numbers are already coming out, and we're already seeing that we are in a recession, at least technically, as well as a bear market in the market. So realistically, there are probably a bunch of people at the economy who shouldn't be here. So by him announcing this ahead of time, he's hoping that a lot of these employees are going to just think, oh, I might be losing my job. I better start looking now, and they'll have to leave. He won't have to fire them. That's a smart way of doing it as a CEO, but I think some of you might decide that this isn't the place for you, and that self-selection is okay with me because he obviously doesn't have to do the firing. The Fed had a stress test this year for the banks, and they're saying that the banks could withstand 10% unemployment, which we're at the historic lows right now, but A lot of that is, I believe we're going to start seeing the data coming out that is ticking up. Unemployment will be ticking up. And 55% stock price drop in annual stress tests. So we've already seen 20%. A lot of people are still calling that we're only about halfway there, especially Michael Burry said we're probably about halfway there now. So we might have another 20 to 30% left for the stocks to drop. Could be more, could be less, but that's where a lot of people are putting it right now and pegging it. The Fed sees the banks will have enough capital to keep lending even if unemployment rises to 10% under a hypothetical scenario, which I don't know if it'll get that high, but it probably could get pretty close, just based on how many. The other thing too that people don't think about is all of these gains in jobs that we've had over the months. They're not really gains overall because we lost millions of jobs when the pandemic hit. All of these months that we've been getting data where it's saying we've gained 300,000 or 500,000 jobs, we're still not even back to where we were before the pandemic. So we're just now getting back to a point where it's close. And now that we're getting back to that point where it's close, we're seeing the market again decrease, which that's kind of the inverse relationship that they have. The lower the unemployment is, usually the lower it gets, the closer it indicates us getting to a recession because the markets really just haven't been able to keep unemployment and the market continuing to increase. That's just the inverse relationship they have with each other. This year's hypothetical scenario is tougher than the 2021 test by design, includes severe global recession. So we're seeing that all around the world right now, that there is a recession taking place globally. China, Russia, Europe, Africa, all of these, India, the Middle East, all those countries, as well as the United States, Canada, we're all going through some type of a recession. We just don't know how bad it's going to be. And we'll be getting those numbers, in real time. But a lot of times when you're in a recession, you don't know how bad it's going to be until you're already in it and you're already experiencing it. So the Fed's model included 5.75% increase in unemployment to 10%. So I think we're only around 3%. They're saying that that's going to get up to 10%, but and a 40% decline in commercial real estate prices and 55% drop in stock prices. So, I mean, commercial real estate has been pretty solid, recently. There was a time right in the pandemic where commercial struggled a bit, but we did see that really kind of come back a little bit recently. And I think, that would be an indication of what they're expecting for not just commercial, but I would think residential as well. I know everybody keeps saying residential is not going to fall. I just don't agree with that. Everything happens in cycles in the economy, no matter, how great things have been for how long. There's always cycles. Sometimes they're later, sometimes they're earlier, but it's a cycle. Whatever comes up, whatever goes up must come down, or at least go back to where it was on par. So the last one is the GDP, and that came out just a couple days ago. The Atlanta Fed revised their GDP. They were projecting that GDP would be a negative 1%. They've now revised that down to negative 2.1%. So they've revised it further. And when we get to the actual numbers, we'll see if that is even lower than that. So just to put it in technically, a recession is 2 quarters simultaneously of negative GDP growth. We are now looking at the second. We just finished the first half, so that's 2 quarters in. And we are looking at now having the second negative GDP growth put in. So I think that is going to be the indication really for, what we've been talking about as far as us going into the recession. We're only halfway through the year. I think we have quite a bit more to go. And like a lot of them have been saying, with Michael Burry, let me just real quick get back to that. Michael Burry is talking about the bullwhip tweet. So he's been talking about this for a little while, but he issued a tweet Monday suggesting that the Federal Reserve may pause or even reverse its campaign of interest rate hikes, as I've been saying that they probably would. You need to look no further than the U.S. 2-year bond market. Just watch that bond market and you'll see what they're going to end up doing. Now, they're probably going to try to raise the rates again. I would assume 0.75 to 0.5 to show that they are in control, which they're really not. They're just following the bond market. What he's really referring to, the bullwhip effect, is deflationary effects of retailers holding too much inventory. So we had all that inventory backed up and stocked in those cargo containers and boats. We had all those issues with the supply chain, the distribution through the trucks. All that stuff was backed up, and now that they've raised interest rates, the economy is slowing down. So buyers and consumers are not buying as much, but we still have all that backed up goods that all these different retailers ordered because they were trying to keep up with the huge jump in demand that we saw in the beginning of the pandemic. So once that huge demand, they started overbuying to keep up with the demand. Now demand's waning, and they still have all of that stuff coming in. And what's going to happen is basically it's going to be sitting there, and that's going to force prices to drop. Some retailers are actually talking about paying people not to return their goods. So they're actually going to give them the money back and allow them to keep the goods that they don't necessarily want, because it's going to be more efficient for them to keep up with their supply chains. So most all commodities are in correction mode, with Bloomberg Commodity Index down more than 10% since June 9th. This is the tweet itself. But really, that's what it comes down to, is that there's going to be, he's thinking that there's going to be a bullwhip effect, which basically like the cracking of a whip. It winds up, it's really slow to come back, but then when it cracks, you see the retailers are going to have to really fire sale a lot of products and goods to keep up and to make sure that they're actually making sales or have some kind of income coming in. So that will decrease prices, and from there, that's where the market and the Fed will probably end up reversing course. I would expect one more 0.75 rate hike, and then as the bond market's already starting to drop, I think we're going to see the Fed capitulate and decide that they're going to begin easing again, which is what I've been talking about. I think they were only raising the rates really enough to give themselves some room to try one more time and go back into a easy money policy again. Before they do some kind of I believe they're going to do some kind of a reset with the financial markets, with the dollar, or with this new cryptocurrency that they do have coming out. The Fed is going to be releasing that in 2023. So stay tuned for that as well. But that's really it for today. Well, that's it for this week. If you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to check out the link in the description to get access to our MLS search engine and tons of free tools, resources, and hot lists. And if you ever want to connect or chat, my info is in the link as well. As always, stay safe, and I'll see you in the next video.